Ladies and gentlemen, good day and welcome to the Anupam Rasayan India Limited second quarter earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kanav Khanna from Christensen Advisory. Thank you, and over to you, sir.
Thank you, Aman. Good afternoon to all the participants on this call. Before we proceed to the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause future result performance or achievement to differ significantly from what is expressed or implied by such forward-looking statements. Please note that we have mailed the results and the presentation, and the same are also available on the company's website. In case you have not received them, you can write to us and we'll be happy to send it over. To take us through the results and answer your questions today, we have the top management of Anupam Rasayan India Limited, represented by Dr. Kiran Patel, Chairman and Executive Director, Mr. Anand Desai, Managing Director, and Mr. Afzal Malkani, Chief Financial Officer. We will start the call with a brief overview of the quarter gone past and then conduct Q&A session. With that said, I will hand over the call to Dr. Kiran Patel. Over to you, sir.
Thank you very much. It is indeed a great pleasure for me to welcome each and every one of you to the second quarter FY22 earnings call. First, I hope you and your families have enjoyed the Diwali festivities, and I take this opportunity to wish you all a very happy, healthy, and a prosperous New Year. Coming to business, we now have ended yet another quarter successfully, meeting and in fact exceeding our defined targets. We have overcome the year's turbulent environment, including supply chain challenges and the third peak of COVID, and were able to deliver value for our customers as well as our shareholders. Anupam Rasayan will not deviate from its core principles of quality, innovation, environmental sustainability, and human and social responsibilities. Taking this legacy forward, we are now attempting to transfer ourselves into a fully sustainable business in every way. We have partially shifted to renewable energy, that is solar power, for our energy consumption requirements. We are using natural gas-based steam to run our plants and have tried to minimize our dependency on fossil fuels. We have successfully installed a solar power plant in Bharuch that will not only impact the environment positively, but will also reduce the cost of electricity and the product manufacture. We intend to further increase our investments in renewable energy in an effort to decrease the proportion of our overall fossil energy consumption. I want to highlight that our growth and profitability results from an increase in the number of molecules manufactured by us, an increase in our installed capacity, and increase in the R&D. Innovation in the synthesis and manufacturing of all life science related and other specialty chemicals that need multi-step synthesis and sophisticated technologies. These factors distinguish us from our competition and allow us to partner with a broad base of Indian and global clients. The core DNA of re-engineering process sets us apart from the competition and results in customer stickiness and also the addition of new ones. The quality of our earnings will demonstrate that we have broadened our customer base and also increased our geographic footprint, resulting in decreased percentage of revenue coming from our top customers. As our partners and shareholders, you will be happy to hear that our company not only has progressed in the use of renewable energy, but is continuing to grow at a faster rate than our industry growth rates, at the same time maintaining a very healthy profit margin. This technology is at the heart of our operation. We are able to add value to our customers by cutting down the number of steps in the processes, resulting in cost savings to both our customers and our company. Anupam's dedication to innovation and quality has spanned for more than 3 decades. We will continue to make a determined effort to ensure that we remain the industry leaders and continue to grow organically at a healthy pace. At the same time, we will be seeking investment opportunities for inorganic growth that will complement our core business. I will be happy to report our continuous progress transparently to our shareholders. This now concludes my remark, and I will hand over the call to Mr. Anand Desai, our Managing Director, under whose able leadership will continue to grow in this manner. Thank you. Anand?
Thank you, Dr. Patel. Hello to everyone. I'm delighted to meet you everyone again after what I believe was a very good quarter for our company to discuss the developments and results of the quarter gone by. To begin, I wish you and your family members a very happy Diwali and New Year. We continue to deliver value to our stakeholders by the means of increased margins through our financial and operational performance. In Q2 financial year 22, our cost containment measures and operations contributed to savings reflected in our bottom line, with our profit after tax at around 36 crores in absolute terms and a profit after tax margin of 14%, an expansion of around 300 basis points over the previous year, Q2 FY21. This expansion in PAT margins was led by the adherence to this deleveraging undertaken by the company post-listing. And I want to reiterate what we announced in the last call, that we have successfully achieved our IPO target of rupees 563 debt reduction and a finance cost reduction of rupees 1.4 crores vis-a-vis Q1 FY22 and rupees 12 crores vis-a-vis Q2 FY21, which can be seen in our financials. As mentioned by Dr. Patel, we have successfully completed the installation of the solar power plant in Bharuch, which we expect will give us a saving of around rupees 4 crores in the remaining period of this year and rupees 10 crores per annum next year onwards. As discussed in the earlier calls, we are in the process of renegotiating our prices with our customers, and the new prices will be levied January onwards. This is a general phenomenon. In this quarter, we have added 4 new molecules, which are all pertaining to life science division. Also, as indicated through the stock exchanges, we have secured 2 new LOIs this quarter. One from a Japanese multinational company worth 135 crores, and another is an existing European multinational company, which is one of the top 10 multinational companies across the globe, which was worth 145 crores. Both are for supplying a life science related specialty chemical product. These orders will further strengthen our revenue and profitability and showcases the quality of the products, allowing the customers to depend upon the company on a long-term basis, making us a preferred partner for these MNCs. As you know, China Plus One strategy continues to realign the global chemical sector and continues to be a tailwind for the Indian chemical industry. Our key goal is to remain focused on specialized niche molecules and continue expanding our product portfolio with the help of our strong R&D and technical capabilities. Our continued value engineering efforts to provide our clients with high quality products have also contributed to our revenue expansion this quarter. The focused execution of our strategy, fueled by our strong capability and track record of commercially manufacturing products, deploying continuous process technology, including macroeconomic factors and industry sentiments, position as a preferred partner of choice for our key clients who are seeking a long-term reliable partner. This enables us to increase our wallet share with existing clients and grow our market share while maintaining competitive pricing. We are continuously working on various molecules in both life sciences and other specialty chemicals in our R&D at this moment. Now I hand it over to Mr. Anupam Rasayan, our CFO, for the financial year overview of the company. Thank you.
Thanks, Anand. Thanks, Anand. Good afternoon, everyone. We are glad to announce that once again we have delivered an excellent quarter in terms of both revenue and profitability. Now I would like to briefly touch upon the key performance highlights for the quarter ending in September 2021. For the quarter Q2FY22, we reported consolidated total income of 249 crores, registering a YoY growth of 13%. The consolidated EBITDA, including other income during the quarter, grew by 10%. It went from 63 crores in Q2 to 70 crores in Q2 2022. This EBITDA margin increased from 26.60% in Q2 2021 to 27.5% in Q2 2022. Our profit after tax stood at rupees 36.20 crores. The PAT margin is 14% in Q2 2022 compared to 11% in Q2 2021. Our interest cost has reduced from 17.26 crores in Q2 2021 to rupees 5.21 crores in Q2 FY22. Coming on to the performance for the H1 2022, our revenue from operations stood at 482 crores compared to 365 crores in H1 2021, registering a growth of 36%. Our EBITDA, including other income, is rupees 135 crores in absolute terms. In terms of margin, compared to 25.70% in H1 21, it was 27.40% for H1 22. It shows an improvement of about 1.8% year-on-year basis. Compared to H1 21, our interest cost reduced by 23 crores in H1 22. Our profit after tax stood at rupees 68 crores in H1 22 compared to rupees 26.5 crores in H1 21, registering a growth of 157%. The PAT in percentage terms increased from 7% in H1 21 to 14% in H1 22. Now moving on to the segment-wise performance for the quarter 2 to 22, our life science segment contributed 225 crores compared to 205 crores in Q2 FY21. While other specialty chemicals contributed 24 crores compared to 28 crores during the same period last year. In percentage terms, life science segment contributed 90% of the total revenue and 10% from other specialty chemicals. Again, we can say that all our segments have grown equally, whether it is crop protection, personal care, pharma, pigments, and polymer additives. As far as revenue breakup in terms of geography is concerned, in Q2 22, the contribution of India was 43%, Europe 18%, Japan 13%, Singapore 14%, China 8%, and remaining 4% from the rest of the world. For the whole year FY22, we expect that the proportion of export sales will be 60% and domestic 40%. So in FY22, the maximum growth will come from the export market. We commercialized 4 new molecules in Q22, and we are planning to commercialize about a total 8 new molecules in the current financial year, which will significantly contribute to our growth in FY22. Our top 10 customers contributed about 76% of the total revenue. However, there are total 24 products in this. Now may I request the moderator to open the forum for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their question to 2 per participant. If time permits, you may join the queue for any follow-ups. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Shanti Patel from Shanti Patel Investment Advisors. Please go ahead.
Good afternoon, sir. My question is, how much you are expecting return on equity for the year ended 31st March 22?
Yeah. We are expecting return on equity of about 10% in FY22.
So that is not too low?
Okay. So, yeah. So this is due to the lower fixed asset turnover ratio. As you know that we have incurred a front-ended capital expenditure of 800 crores in last 4 years. I'm explaining the reason why this ROE is too low and how we are planning to improve it. So as I mentioned, in the last 4 years, we have done a front-ended capex of 800 crores in last 4 years. And out of the above capex, we commercialized major projects in March 2020. And in FY21 was the first year of commercialization of the project, in which our average capacity utilization was only 50%. This has resulted in a lower fixed asset turnover ratio and consequently lower ROCE. However, we are going to achieve a revenue of rupees 500 crores in FY22, means the current year, and 750 crores in FY23 from these new recently commercialized units. So in view of the above, this fixed asset turnover ratio is going to improve from 0.76 in FY21 to 0.95 in the current financial year, and is further expected to improve to 1.3 in FY23. So we believe that in specialty chemical industry, a time comes for every company once in every 5 to 7 years when they need to invest heavily in infrastructure for the future growth of their company. And in this year's ROC and ROE are little bit down. So on the ROC part, it was 11% and expected to improve to 14% by the end of the current financial year. And our ROE, which is expected to be in the range of 9 to 10%. And next year, when we will be able to start effective utilization of our newly commercialized units, it will expected to further improve to 13 to 14%.
Okay, thank you, sir.
Thank you. Next question is from the line of Ankur from Axis Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. The first question on the margins front, especially gross margins, and your thoughts, the expansion in this quarter, and your thoughts overall on the RM inflation trend that we are seeing across the company. Is it the margin growth that we are seeing? Are we seeing sustainability here, or probably there could be some pressure going ahead on this front?
Yeah, so you can consider the current the gross margin is about 62 to 63%, and you can consider of about 58 to 60% as a sustainable gross margin going forward. And in terms of EBITDA margin, you can consider a range of 25 to 27% as a sustainable EBITDA margin.
Sure, sir. And any headwinds there on the RM availability or the supply chain issues or pricing side that we have seen? And I'm also referring to the inventory rise that we have seen in this quarter. whether the jump in inventory is largely to protect from the supply chain disruption, or how should one look at it?
Yeah, Ankur bhai, I will try to answer your both the question. One is to cover this price volatility in raw material price and this inventory, because both are linked with each other. First, the main reason for this inventory, as we discussed in the last one also, that the main reason for this inventory is to safeguard against the price volatility risk, as we offer a single price to our customers with whom we have a contractual agreement, and therefore to mitigate the price volatility risk, we keep 6 to 7 months of inventory. Also, in addition to that, certain agreements with our key customers require us to keep a minimum inventory because our customers are largely depend on us for their supply chain. Now, the most important point is that our inventory has increased in H1 2022, particularly in anticipation of significant increase in raw material price arising from the increase in crude price, supply chain disruption in China post-COVID, threat of the third wave of pandemic, non-availability of vessels and containers in China and Japan, and significant increase in shipping and logistic cost. So, considering all these situations, our inventory have further increased in H1 2020. But however, I would like to add here is that if we had not maintained this level of inventory, we would not have been able to supply material to our customers with whom we have a contractual agreement. And we were able to register a growth of 36% in H1 2022, despite the negative impact of pandemic on supply chain across the globe. Also, you can see that despite the increase in the price of couple of raw materials by 100% to 200% in last 6 months, we were able to maintain our EBITDA margin of more than 27% in H1 2021 due to this inventory holding policy. Yeah, does that answer your question?
Yeah. Thank you, sir. Sure. And just one last bit. The asset turn guidance which you mentioned earlier, for the earlier question, and along with that, the new contract wins, LOIs that we have in terms of new customers. Should we see these, LOIs or incremental order wins as incremental to whatever that guidance is, or your guidance already factors in such sort of, contract wins that we have?
Yeah, out of these two LOIs, we can consider 135 crores and second is 145 crores. In our guidance, we have not covered the LOI of 145 crores which we received in the month of September.
Okay, so if I roughly do 1,000 crore gross block into 1.3 is 1,300 crore revenue, and 140, 150 crore will be top up to that.
Yes, but this is not in a 1 year, this is in a 4 years, this contract.
Okay, 140 crore revenue over a 4-year window.
Yeah, 4 years. Yeah.
Sure. Okay. That's thanks for the clarification. That's it from my side. I'll get back into this. Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. Also, before we take the next question, I'd like to remind the participants to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. The next question is from the line of Abhijit Akela from IIFL. Please go ahead.
Yeah, thank you and good afternoon. Just 2 questions from my end. One is, if you could please just update us on the status of the discussions with customers regarding the changing of the pricing cycle from annual to semi-annual. How is that going along, and by when can we see some benefits from that?
Yeah, sure. So we have already proposed to our customers a pass-through mechanism from next year onwards. We have proposed to fix the price on a yearly basis instead of yearly, as we discussed last call. Our customers are very cooperative in solving such genuine problems, and we are sure that we will be able to convince them. And after the implementation of half-yearly pricing mechanism, we will be able to curtail our inventory significantly. And this price negotiation with customers starts in every November and complete by 15th December. On the basis of preliminary discussions, we believe that most of our customers will agree to this from next year onwards.
Okay, thank you. And the second one was just, given our full year revenue growth guidance of 35% provided earlier, we'll need to show quite a significant acceleration in revenue run rate in the second half of this year compared to the first half. So just to check whether we have orders in hand that give us sufficient visibility into this jump in the second half to say around 600 crore plus of revenue in the second half.
Yeah. First, there are three growth drivers for this H2 2022. First is the higher capacity utilization we are expecting for our unit number 5 and unit number 6. In the H1 2022, the average capacity utilization for our unit number 5 and 6 was about 70%. Now we are expecting this capacity utilization in the range of 75 to 77% for these two commercialized units, unit number 5 and unit number 6. And even if you see the revenue pattern of the company for the last 5 years, and due to the seasonality of a couple of segments, then in general, every year we achieve 45% of the total estimated revenue in H1 and 55% revenue in H2. Considering this ratio, we have achieved this H1 revenue, and on the basis of that, we are confident that we will be able to achieve our target for H2 2022.
Understood. No, that's helpful. Thank you so much, and wish you all the best.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Thank you and good afternoon. My first thought is, can you explain why the other expenditure in the second quarter has gone up so much? What are the reasons? And is it something of one-off, or is it going to be a similar trend in the second half and the years ahead?
Yeah, if we talk about the increase in other expense, then there are a couple of reasons for the increase in other expense. In percentage terms, other expense have increased by 38%. However, on the other side, our sales have also grown by 13% compared to the corresponding quarter. But the major increase in expense is due to the utility expense, particularly gas and coal expense, which is directly related to productions. The total increase in this expense is about 70% due to increase in the gas price as well as increase in the coal price. In addition to that, our pollution expense have increased by 40%. And apart from this, our logistic cost has also increased significantly by 300% due to the increase in volume as well as increase in price due to the pandemic situation.
Okay. So, and in terms of your overall business, how much of your business is driven by a long contracts of say 3 to 5 years where you have fixed margins, and how much are based on annual revenue generated on merchant business?
Approximately 60 to 65% revenue comes from the contractual agreements of say 3 years, 3 to 5 years, or 7 years. And the 20% revenue comes from the on an annual basis. Though we don't have for this product, we don't have any contractual agreements, but we have a long track record of offtake from our customers, and we have been supplying this product for the last 10 years. So we can say that we have a clear visibility of about 80 to 85% of the total estimated revenue.
Okay. And if you look at your long-term contracts, they're based on fixed margins, which are renegotiated every year. How does it work?
Yeah, we have been working on an open and transparent cost model with our customers. As per our current practice, we give a single price on an annual basis with our customers. In every December, we give a single price for the ensuing calendar year. But as we discussed, that now we are going to propose to our customers a semi-annual pricing mechanism for the next year onwards.
Okay, thank you very much. I'll join the Q&A show.
Thank you. A reminder to participants, please press star and 1 if you wish to ask a question. The next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I have just one question. You have mentioned in your presentation that you are in the advanced stage for one of the electronic chemicals. So just wanted to understand whether you have planned any capex, or do you have any kind of visibility on the revenue side for that particular molecule? That's it.
Yeah, particularly for this product, now we have been working in R&D and pilot facilities, and at the initial stage, we will be working at our existing manufacturing facilities only. For particular this segment, we don't need to incur any capital expenditure at this point of time.
Okay. And do you have any kind of revenue visibility for this particular product?
Currently, we have been working on that, and we will be able to finalize with our customers by end of this quarter.
Okay. Okay. Thank you. That's it from me.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. A reminder to our participants, please press star and 1 if you wish to ask a question. Next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir, for talking. So I just wanted to understand.
Deepak, can you speak a bit louder, please?
Is it better?
Yes.
Yeah, so I just wanted to understand, is there any kind of outlook that you have given for the next year in terms of growth and the margins?
Yeah, particularly if we talk about the growth, then we have been growing at a CAGR of 30% per annum in the last 3 years, and we hope to continue the same growth trajectory for the current year as well as at least for the next year. And in terms of margin, we can say that we will be able to maintain our EBITDA margin in the range of 25 to 27%.
Thank you. That's it from my side.
Thank you. Next question is a follow-up question from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Hi. So if you look at your longer-term growth, is there any further requirement of CapEx to continue to generate additional long-term contracts? How does your business model work? Do you have to continue to create what they call multi-purpose plants for the next few years?
Yes, as I mentioned that we have been growing at a CAGR of 30% per annum, and we expect the same growth trajectory to continue till FY23. And we have sufficient capacity available to achieve the projected growth till FY23. But yes, to take care of the growth from FY24 onwards, we need to start the expansions. Also, we have recently executed a couple of LOIs discussed, for which we will need to do a capex by end of this year. So we are going to start a capex of about 200 crores from the beginning of the next quarter, and this gives us a revenue of about 375 to 425 crores at the peak. And this capex will be modular capex, and there will be 3 different projects for different molecules. And we are planning to start expansion in the last quarter of 2022, and this project is expected to be commercialized by Q2 2023. Because we have been working on more than 70 molecules in the R&D and facilities, and we are hoping to commercialize about 8 products every year. So to continue the similar growth momentum, we are planning for the expansion, the capex of rupees 200 crores.
And in terms of competition, you talk about maintaining this kind of margins. How does it give you confidence that you can sustain? Because there seems to be a lot of interest in this business model across the Indian chemical space. So what gives you the kind of pricing power? Is it the growth in demand, or is it any specialized areas you're working on? How does it really help you get these kind of margins on a sustainable basis?
Yeah, sure. So generally, we don't compete with any domestic companies. And also, as I mentioned, that in our existing business, we are either a sole supplier or second supplier for over 60% of the revenue of any financial year. And we have long-standing relationships with major customers with significant entry barriers. And also, as a key strategy, we also to maintain our margin, we always explore either backward integration or forward integrations to remain competitive. And apart from this, we continuously explore the possibilities to convert existing process into the continuous process. And currently, we manufacture many products or many steps in the continuous process. And we always continue to focus on identifying alternative routes to reduce the consumption of raw material and solvent and minimize the effluent generation. Due to this, there is a significant saving in cost, which allows us to pass this benefit to our customers. So in that way, we are able to maintain our margin.
Thank you very much. Have a nice day.
Thank you. The next question is from the line of Satish Warrior from Sundaram Mutual. Please go ahead.
Yeah, thanks team. Thanks for the opportunity. I just one question. If you look at our first half numbers, three questions from that. Some guidance can you give in terms of inventory? How do you see that? Because we have built up inventory, looking at RM inflation, etc. So guidance for that. Second, when you are talking about ongoing capex, just can you walk through how will that capex we will plan to do either through debt or will it be internal accrual? So just can you talk about a little about how cash flow build-up will happen for second half and going into next year, please? Thanks.
Yeah, sure. Your first question is about the inventory guidance. So in FY21, our inventory period was 220 days, which was increased to 240 days in H1 2022, as we discussed in earlier questions. However, after implementation of our half-yearly pricing mechanism with our customers, the inventory level will improve to 185 days by March 2022. Your second question is about how we are going to fund the capex of rupees 200 crores. This will be in the judicious mix of internal accruals and debt.
Okay. Outside of this 200 crore capex also over the next 2-3 years, we will be implementing further capex also, right? Outside this 200 crores. So what will be our just can you a little bit talk about what will be our cash flow generations over the next 1.5 years? Because you gave a guidance on inventory. If you see your OCF has been negative for the first half, how that should plan out in the second half and the next year?
Yeah, this cash flow was
revenue, right? So that's why I asked.
Yeah, this cash flow was negative in H1 due to the higher working capital requirement, mainly due to the marginal increase in inventory as we discussed. But if we see as per our projection in H2 2022, as a whole year, our cash flow will be 155 crores by 2022. And next year, in 2023, we are expecting the cash flow of about 250 crores.
Okay, thank you. And outside, just last one, outside the 200 crore capex guidance for next year, is there any further capex plan outside the 200 crores? Thanks.
No, currently we don't have any other capex plan.
Okay, thank you. I'm done. Thanks.
Thank you. The next question is from the line of Madhav Mada from Fidelity Investments. Please go ahead.
Yeah, hi, good afternoon. Thank you so much for your time. I just wanted to get some more clarity around the capex for FY22 and 23. I'm not very clear how much do we plan to spend in each year in the current outlook.
Yeah, currently if we are going to start the capex in the last quarter of 2022. So you can consider that 30 to 40 crores in the fourth quarter of 2022, and after that the remaining capex will be completed in FY23.
So the total capex for FY22 will be close to 170-180 crores. Is that right?
No, particularly if we see in H1 2022 means 30th September 2021, we have incurred a capital expenditure of about 90 crores, which includes 45 crore rupees for the installation of a solar panel, and remaining 45 crores was for the installation of the hydrogenation facilities as well as the new R&D and pilot facilities. This is about the 90 crores. In addition to that, the additional capex out of this 200 crore capex, 30 to 40 crore rupees will be incurred in Q4 2022. And remaining CapEx out of this 200 minus 40 crore rupees, 160 crore rupees will be incurred in FY23. So, answer your question. For the financial year 2022, the total CapEx will be 90 crore rupees till date and 40 crore rupees for this new project. 130 crores will be the CapEx for the financial year 2022.
Okay, so 22 is 130 crores and FY23 is 160 crores. That's the current outlook.
Correct. Yeah, that's correct.
Okay. And the inventory days, we plan to bring it down to 180 days by March 2022. Do we have any more plans beyond that as well? That, in FY23 we want to further bring it down by another, say, 20-25 days by further renegotiation. Is that also something that we are considering?
Yes, definitely. Our planning is to further reduce to 150 to 160 days.
Okay, cool. So by FY23, got it. Understood.
Yes. By FY23, it will be in the range of 150 to 160 days.
Got it. And on the inorganic side, is there any particular target company that we are evaluating which looks interesting to us? And is there like a timeline that we have by when we would like to finalize?
So, Madhavji, we have been evaluating potential acquisitions in specialty chemicals, and we will continue to actively evaluate for the inorganic growth. Currently, we have been considering a couple of potential targets, but however, we are very meticulous and selective in this process. But as of today, nothing is materialized. And particularly, they are planning for the acquisition that acquisition should synergies in terms of products and customers. Either they should help us the backward integration or forward integration in our existing business.
Okay, understood. All right, sir. Thank you so much for that. Thank you.
Thank you. Next question is from the line of Ankur from Axis Capital. Please go ahead.
Yeah, hi sir. Thank you. So two follow-ups. So one on the R&D side, especially when we commented that technology being the key focus in terms of product development, etc. Any significant investments that we are doing there, and our thoughts?
Yeah, that the investment of about the total we are doing the investment of about a total 20 to 25 crore rupees in the R&D and pilot facilities, out of which we have already incurred 18 to 19 crores, and the balance of 4 to 5 crore rupees will be incurred by the end of this quarter. And also, also in addition to that, I would like to add here is that we are a R&D driven company, and we have made substantial investment for R&D in 2018 also, about 25 crore rupees, when the company's revenue was only 340 crores. And apart from this, we have added 38 new employees in R&D in last 2 years, which includes PhDs, chemists, and other professionals. So taking the total strength to 62 as on 30th September, and this will further increase to 70 people by this year end.
Sure, sir. That's helpful. And secondly, Mr. Patel also mentioned, the focus on the renewable energy or investment in the solar asset. So how much of any internal targets that we have wherein we want to increase the renewable share to be X percentage, and how much what could be the timelines for that and the possible investments over there?
Yeah. Currently, we made an investment of about 12.5 megawatts, and it could be total amount of 45 crore rupees. And this will serve over 20% of the total requirement, and this will give us saving of rupees 10 crore rupees, as mentioned by Anand Bhai in his opening remarks. So apart from this, we are also planning for the solar panel of about 8 to 10 megawatts, and planning to invest another 30 to 33 crore rupees in next quarter. So you can consider from the April 2022.
Sure, sir. And this will be over and above the 180, 160 odd crores capex that you talked of earlier. So 160 plus, let's say 30, so around 200 odd crores capex there.
Yes. For this, cost reduction measure like the solar, this will be in addition to the normal capex.
Sure, sir. And just one data point which I missed. You mentioned this 200 crore of incremental, capex. This should drive what sort of revenues for us, and by what time frame?
It will be in the range of 375 to 425 crores.
Okay. So, and these are, I presume, all productive assets wherein the asset turns are slightly at 1.82 times average.
Yeah, definitely. Yeah.
And the starting of this revenue will be FY24, or we'll see some bit of it coming in FY23 also.
Yeah, these are the three projects, and the expected date of commercialization is June, July 2023.
Okay. That's helpful, sir. Thank you and all the best.
Thank you. Our next question is from the line of Rohit Nagraj from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Sir, again, delving on the capex front. So for this 200 crore capex, do we have all the approvals in place to start by, say, Q4 of this financial year?
Yes, we have all the regulatory permission for these three projects. As well as we have a surplus land is also available and the regulatory permission also available.
All right. So in terms of surplus land available, what size of projects can be accommodated further once this initial 200 crores has been invested?
Yeah, out of these three projects, two projects are in crop protections. One is the insecticides and one is the fungicides. And the one project is number 3 within the pharma. So out of these three projects, two projects will be the Jagadia, our unit number 5, from where we have a surplus land available. And the one pharma project will be in unit number 6 at our 13 units, where we have a surplus land and regulatory permission available.
Right. Got it, sir. So just one clarification on the long-term contracts. I understand we are making probably some part of the plant as dedicated for these products. So do we have any take or pay kind of an arrangement with the off-takers?
Yeah, we have almost 6 to 7 contracts with our existing customers. Out of this 7 contracts, in a couple of contracts, we have a take-or-pay kind of clause included in the contract.
Right. I was talking more about from the future contracts. So the last 6 months, we have received 4 new contracts, long-term commitments on those ones.
So in the new contract, out of these 2 contracts, in one contract we have take or pay type of clause we have incorporated, and for the second contract, though we don't have any take or pay type of clause, but we have minimum guaranteed offtake from the customers that we mentioned.
Right. And just one last clarification in terms of debt. What do we see the debt profile by FY22 end and by FY23 end?
If we see the total debt profile, then as on 30th September 2021, our net bank debt was about 90 crore rupees, 40 crore rupees about the term loan, and 50 crore rupees working capital requirement. By this end of this March 2022, our total bank debt would be in the range of 140 to 150 crore rupees, mainly 100 crore rupees working capital and this 40 crore rupees for the term loan.
Got it, sir. Thank you so much, and best of luck.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to Mr. Afzal Malkani for closing comments. Thank you, and over to you, sir.
Thank you. So to summarize the discussion, I would like to state that with robust order book and looking to the new product inquiries, we are confident that we will be able to maintain growth momentum as we move forward. and we really appreciate the support of our investor community, and will strive to do our best to further improve our performance. The outlook for the coming quarters remains positive, and we are confident that we will be able to maintain momentum as we move forward. Finally, once again, we would like to thank our investor community for their support and faith in us. We hope we have been able to answer all your questions satisfactorily. If you have any further questions or would like to know more about the company, we would be more than happy to be of assistance. Also, you can contact our IR agency, Christensen, if you feel like. Stay safe, stay healthy. Thank you once again for taking the time to join us on this call.
Thank you very much. Ladies and gentlemen, on behalf of Anupam Rasayan India Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.